First, let us discuss on the basics of derivative. What is a derivative? A derivative is a contract or a product which derives its value from an underlying asset. For example, if I'm trading Nifty future, the Nifty future derives its value from the underlying asset, which is Nifty itself. So there has to be an underlying asset if there has to be a derivative. So a product that derives its value from an underlying asset is known as a derivative. So what are the various products in derivatives market? The first is the forwards, then futures, options, and swaps. The major market participants in this segment would be hedgers, speculators, and arbitrageurs. We will discuss in length about each one of them. What are the types of derivative market? A particular derivative instrument can either be traded over the counter, which is denoted as OTC, or it can also be traded across an exchange, so which is known as exchange traded. So there are basically two types of trades that are possible in the derivatives market. It can either be over the exchange or over the counter. What are the major risks that the participants in derivative market would face? The risks are predominantly the counterparty risk, price risk, liquidity risk, regulatory risk, and operational risk. Let us understand a little more about each one of them. Counterparty risk. This type of risk predominantly exists when the trade happens over the counter, because if the trade is happening over the exchange, then the trade is guaranteed by the exchange, and hence you would not have counterparty risk when the trade happens over the exchange. Whereas in case of trade happening over the counter, there are no standard terms of the trade, and the other party with whom you are trading might default. Such a scenario is known as a counterparty risk. Second is the price risk. Of course, we are all aware that the price of any particular stock or an index or a commodity for that matter that we would be trading keeps moving, and there is always a risk that the price would move against our will. So if we are long on a particular market, the price may start going down against your view, and that is basically known as the price risk. Third, liquidity risk. It's a very important concept. As an investor or a trader or a speculator, I would first ensure that there's enough liquidity for the particular product that I'm going to trade. Sometimes it happens that we buy a particular stock or an index or a derivative, and at the end of the period, there is not sufficient liquidity. That is, there's no counterparty who can buy when you're selling or can sell when you're buying. So this is basically known as the liquidity risk. Next is the regulatory risk. This risk basically talks about various changes made by the regulatory, be it from SEBI, RBI, or Government of India from time to time. These cannot be forecasted, but however, whenever there's a regulatory change brought into the system, it comes along with a risk. The last risk category is the operational risk. This predominantly deals with the front office, middle office, and back office, wherein there are chances of an error while taking an order or while passing an entry in the ledger. So it's basically an in-house risk that is run by a broker.